My name is Susan. Let's talk about the different business assets and investments your company owns. The two broadest categories of business assets are those that are tangible and those that are not. Assets can be real or tangible, like a car or a computer you use for business or retail shelving. They can also be intangible, like intellectual property, trademarks, copyrights, patents. The most common way to value individual assets is by determining their fair market value. This value is the price an asset brings in a sale between a willing buyer and willing seller, neither of them compelled to buy or sell. Most small businesses use the current market value of assets to determine their value. Since this is the value of the assets if they were all sold, you should consider using their after-tax value. If you aren't certain of an asset's value, you can get it appraised. Large companies often use a cost approach to valuing assets. This takes the original purchase price of all assets and the cost of any improvements on them and subtracts depreciation. This is good for showing a company's profitability, but it doesn't show the asset's real sale value. There are different types of investments that your business can choose from, such as bonds, stocks, mutual funds, real estate, and more. Your choice of investment will depend on the business's financial goals, your risk tolerance, and the investment capital the company is capable of. Stocks, also called equities or shares, may be the most well-known and straightforward type of investment. With this investment, your business essentially has partial ownership of the company it has a share of. The more shares of a company your business owns, the more of their profits and assets your business is entitled to. Real estate investment involves buying properties, houses, condominiums, lots, apartment units, etc., to sell them or to rent them out to tenants. Real estate is a relatively safe investment because the property's value can increase over time, and it provides you with steady passive income. A bond is a long-term fixed income investment. In bond investments, a business can lend money to a company or government in exchange for a certain amount of interest over a specified term. A mutual fund combines stocks and bonds, however, it is less risky because the money invested is spread out across various stocks and bonds. Moreover, the investment fund will be controlled by a money manager who will invest the money for you to have good profits. There are many investments you can make for your business. Depending with the size and type of business, you may need to discuss with your business partners about the assets which may be ideal to invest in.
Don't forget to like and subscribe to Profit Brain.